What's the purpose of banks, wealth managers, and index funds? Something I've been thinking about recently is how banks, wealth managers, and index funds are just middlemen. They exist to help you preserve and grow your wealth, but all banks, wealth managers, and index funds do is take money from you and give that money to someone else. And of course, they charge a fee for doing so. There's nothing inherently wrong with marketplaces and middlemen in these marketplaces. There's only something wrong if this whole process of capital allocation could be done more efficiently. Logically, bad money increases the need for all of these middlemen. If your money loses value year after year by design, then a large portion of your wealth needs to be with these middlemen. You'd keep very little cash in your wallet, and most of your wealth would be at a bank with a wealth manager or in an index fund. Opposingly, if you had good money, it reverses the need for these middlemen. If your money increases in value year after year, then a large portion of your wealth could actually be just holding the money without any middleman. You'd have no need to hold wealth in a bank, hire a wealth manager, or buy an index fund. Your wealth would preserve and grow your purchasing power for you because the money has a fixed supply and capitalism naturally leads to technology deflation. Keynesians would hear this and think it's terrible. They would argue that the world needs bad money, so someone will finance mortgages, corporations, and other businesses, because we need these entities for growth. Keynesians want you to be forced to perpetually invest your money, even if you don't know what's the best asset to allocate to. But I think this is a terribly wrong perspective. As a society, our goal should be to allocate capital to the best capital allocators and to do so via a free open market with undistorted prices. If there was somehow a way to do this without a middleman, then the market could be much more efficient. My thought is, I think it's possible that Bitcoin actually does this. When you buy and hold Bitcoin, that very act marginally increases the price of Bitcoin for all other Bitcoin holders. Now, existing holders of Bitcoin have more wealth in their savings. In fact, if someone is buying Bitcoin, the price of Bitcoin will go up until at least one other existing holder of Bitcoin decides to sell Bitcoin to consume or invest. Because of Bitcoin's perfectly fixed supply, this system works well for automatically allocating capital to all other existing savers of Bitcoin without a leak. This idea fails with inferior monetary tools because when you save gold, seashells, or dollars, there's only so much wealth that can be saved before society starts allocating resources to gold mining, seashell hunting, or dollar printing. Think the Federal Reserve. This obviously increases the supply of these monetary goods and also moves resources away from productive enterprises and towards the creation of money. Because of this, there's a market-enforced cap on how much wealth can be held in these inferior monetary assets. But this market-enforced cap doesn't exist with Bitcoin. So as more people hold Bitcoin, capital, wealth, or the optionality to spend wealth doesn't get distributed to just one bank, one index fund, or one wealth manager who then splits the wealth into a bunch of small pieces for companies to spend if they wish. The capital or wealth gets automatically distributed to everyone holding Bitcoin. Then everyone holding Bitcoin evaluates their investment opportunities with their increased purchasing power and potentially sees a good risk-adjusted opportunity to invest. This means holding Bitcoin actually allocates capital automatically to the individual who sees the best risk-adjusted opportunity to invest their Bitcoins in a productive business. And it does this without a middleman. In a way, holding Bitcoin in cold storage is what the financial system tried to create with index funds, wealth managers creating diversified portfolios, and banks. Buying and holding Bitcoin allocates capital to other Bitcoin holders most likely to invest next. And the Bitcoin holders most likely to invest next are the individuals that see the best good risk-adjusted return investment opportunity. What's amazing is if everyone begins using Bitcoin as money, society effectively begins automatically allocating capital to the best investment opportunities without any unnecessary middlemen. If this thought process is true, then building an economy on a Bitcoin standard will likely 100x total global wealth. This increase in wealth will coincide with a higher investment hurdle rate because all investments need to outperform Bitcoin on a risk-adjusted basis. This means 100x more individuals having the optionality to pursue only high alpha investment opportunities will lead to absolutely explosive economic growth. Let me know what you think about this. Is this clear? Are there some holes in the argument? Leave some feedback and share if you think this was interesting. Thanks for watching, everyone, and see you next time.